What's up you guys, Sasha here. I get asked a lot of questions around which is the best passive investment platform out there. Is it Nutmeg, is it Wealthify, is it Wealthsimple, or is it Moneyfarm? All of these companies have become incredibly popular. The market themselves to their customers saying that this is the easy way to do investing. This is the way that you can go and earn money without knowing anything about the market. You can let their experts, you can let their artificial intelligence, and you can let their amazing unique funds do all the work for you. You just have to sit back, put your feet up, watch the money grow, and then collect the proceeds at the end. Sounds pretty good, right? So which one out of those would I choose? Well, the answer is none of them. Let me explain. Just before I go any further, let me do a really brief disclaimer. I am not a financial advisor. I can't provide financial advice to you. And if you do need financial advice, please make sure you go and seek it from a suitably qualified professional. Now that that is out of the way, let me tell you a bit about these platforms. In my personal humble opinion, all of these platforms are a massive waste of money. You can go and invest your money via other ways that can also be completely passive without you having to do anything at all, but more on that later. First, let's talk about their fees. Now, all of these companies charge you management fees for the privilege of being able to invest with them, and they're slightly different but almost exactly the same. Wealthify charges 0.6% per year, Nutmeg charges 0.75%, Wealthsimple 0.7%, and Moneyfarm 0.68%. And then on top of these fees, you also have to pay about 0.2% for the funds that the money is invested in, for a total of around about 0.9% per platform. The worst part is, as your money grows, these fees grow as well because they are a percentage of the total amount of money managed. There isn't actually any extra work to do. There isn't actually anything that they have to pay for. Once your money's invested, it just sits there in those funds. There isn't any real extra cost, but it's nice to charge people who have more money invested even more in these fees, isn't it? So if you go and do the basic math, if you take a basic index like the S&P 500 over a long period of time, it's been doing considerably better more recently, but if you average it out over a long period of time, you would probably expect it to earn somewhere between 7 and 9% per year, including all the big down years. And these fees alone are going to be charging about 10% of that money just for the privilege of managing your money. So whatever money you get in terms of gains, however much your money grows, you're going to be paying 10% of that ish to those companies, unless they do much better than the index. Do they? Let's have a look. First up, we have Wealthify, and these guys have data starting from 2017. And if you're on their most aggressive, highest earning, adventurous plan, your investments would have earned 5.46% per year over this period. Just so that you can get an understanding, the S&P 500 grew by about 14% per year during this exact same time frame. Next up, let's have a look at Nutmeg. Nutmeg has a choice of different risk levels, with the highest risk option delivering a massive 55% return over the last 5 years. That's an average of just over 9% versus just 15.8% for the S&P 500 index over the same period. You can see the pattern developing here, right? Remember, these are the riskiest portfolios that each of these investment platforms offers. If you don't go for the highest risk that they offer, if you go somewhere down the middle, the returns are going to be considerably lower than the ones I'm mentioning. I'm giving you the absolute highest that you can earn with each one. All right, next, let's look at Wealthsimple. Their basic investment package for poor people like you and me who don't have 100,000 or more to invest in a complex mix of investments. This basic package still allows you to invest in methodology backed by Nobel Prize winning research. Yeah. For some reason, they don't even publish the results on their website. It must be so good. But if you go to the help center, and you dig around and you search, eventually you can get to this page that I found where you can find out that their 90% equity portfolio has returned 25.22% over the last 4 years. That's 5.8% per year. Now, Moneyfarm does seem to top the lot. They have earned a whopping 60.7% return from 2016 to 2020 in their highest risk portfolio number 7. That's 9.9% per year, which is pretty good. It's only about 1/3, actually just over 1/3 less than if you just had all your money invested in the S&P 500 index, before all the fees, of course. Now, There are many reasons why I don't use any of these platforms, and I am a relatively active investor, which isn't the kind of approach that most people will take. I do get it. But let me tell you what I think people should do, and this is not advice, just my personal opinion, just sharing some random guy on the internet's thoughts on this. This is what I think people should do if they want to invest passively and actually earn the sort of revenue the passive investments should pay them. You see, I have a massive problem with the way that these companies talk to their customers and the way they explain their investments. They say that they use artificial intelligence. Now, as a mathematician and somebody who's worked in the financial services industry long enough, that is a total load of BS. Basic algorithms to just split up people's funds into some number of different types of investments is not the same thing as artificial intelligence. They also say that they have huge teams working on optimizing the investment portfolios between different asset classes, types of companies, etc. And yet, year after year and decade after decade, well, these companies haven't been around long enough for decade after decade, but similar companies to them tend to underperform a basic index of the 500 largest companies in the US all the time. And you can go and look at any research you like to confirm this, from academia down to NASDAQ, down to Standard & Poor's themselves. Even those people who don't want to go and actively invest their money, if they don't want to manage their particular investments in different companies, buy and sell them, if they don't feel comfortable about it, whatever, it is so easy these days to go and invest in the S&P 500 index. My two favorite indices that I personally have money invested in and that I think are really great are two Vanguard ones, VUSA and VUSD. If you're in the US, you can use VOO as well, but in the UK, those are not available. And you can go and just literally mimic the performance of the 500 largest businesses in the US by just putting your money into them. VUSA is in pounds, and that means that your money fluctuates relative to pounds. So if the dollar to pound exchange rate changes, your investment value might change as well, but it kind of hedges your currency fluctuation risk. Or VUSD is denominated in dollars if you want to make sure that you're as representative of what's actually happening in the US as possible. Now, both of these funds charge 0.07%, which is 10% off the basic fee that the others charge, and actually a lot less than that if you go and take into account the extra fund fees that they charge as well. And they allow you to go and invest automatically into all of these S&P 500 companies for no extra fees whatsoever. Now, you can invest in the S&P 500 by opening an account with either Trading 212, Freetrade, or Etoro. Trading 212 have right now, as I'm filming this, suspended new accounts because they've had a flurry of people applying based on what's been happening in the investment markets over the last couple of weeks, but I imagine that they'll probably reopen relatively soon. With Freetrade, you can go and invest in a pound-based VUSA completely for free. You can open the account for free, you can deposit your money for free, and you can then go and invest in that fund without paying anything other than that 0.07% fund fee, but you're not even going to be paying it. It's just going to be taken out of the proceeds, if you like. For the dollar-based VUSD, you will have to pay a 0.5% exchange fee if you're doing it through Freetrade, but that's a one-off fee. Once you've gone and invested the money, there's no ongoing annual management fee on top, which is where the money can be sucked out of your investments over time by these investment platforms. Also, if you open an account with Freetrade or with Trading 212 using one of my links in the description below, you will actually get a free share just for signing up and making the minimum deposit, which is £1 or £2 depending on which platform it is. So that already sounds a little bit better than those other platforms, doesn't it? Now, Etoro is another really interesting option, and like the other two, the platform actually runs in US dollars rather than in pounds. Because it's international, that's the choice they've made, and that actually has some big advantages. Because if you trade mostly US stocks, if you trade US-based ETFs or commodities or other things like that, it means that you don't have the whole exchange rate between the dollar and pound affecting the value of your investments in terms of the numbers that you're looking at and the performance figures. And although that doesn't make absolutely any real difference, it just makes managing those investments, in my opinion, that little bit easier. You have to pay a 0.5% fee to load money into Etoro if your money is not already in dollars, although you can go and use Revolut or some other services if you can to not have to pay even that. But once you've loaded your money in, all the trades are completely free and you don't have to pay any kind of management fees or trade fees or anything like that. So once your money is in for the 0.5%, you can go and invest in the S&P 500 as well if you like, or anything else, completely for free, which is much better value. So if you're interested in checking that out, make sure you go and check Etoro out through the link in my description below as well. Basically, you can tell that I'm not a huge fan of any of these new fancy investment platforms. They don't give you any meaningful choice, in my opinion, because having a choice of 5 or 7 proprietary funds where you don't even really know what your money is actually invested in is not meaningful in any way, in my opinion. And the worst thing is, the funds that you get to choose from will considerably underperform a basic index like the S&P 500 that I mentioned a few times in this video already. And not only that, but they will charge you expensive fees for the privilege of being able to earn less. I hope you guys found this useful. If you have, make sure you smash the like button for the YouTube algorithm. Thank you very much for watching. I really appreciate anybody who gets this far in a video. Thank you so much, and I'll see you guys later.